if that happens, that means silver's going up at a faster rate than gold, and that's when the real fireworks will start.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi, my name is Shane Moran, and I'll be your host for this week's episode of Live from the Vault. Welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Now, this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the vault. And to help him pull back the curtain, we will be joined by popular demand from you, the Live from the Vault community, from the one and only Dave Kranzler, industry expert over at Investment Research Dynamics. That's right. Dave Kranzler is in the vault, and you're not going to want to miss this conversation. Just before we introduce our special guest and head over to the UK, please help us spread the word about this channel by hitting that like button. Not now, but right now. Go ahead, hit the like button, share this information, and if you're not already subscribed, do so. If you want to be notified in real time as each episode goes live, just click on that bell and we'll do just that. Now, Dave Kranzler, for those that are new to the community, he is the founder of Investment Research Dynamics and the Mining Stock Journal, which is a bi-weekly report that focuses specifically on the junior mining stock and lots of ideas in there. And he's been focused in the sector for over 20 years. So be sure to visit Dave Kranzler there at investmentresearchdynamics.com. We'll put a link down below there. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest, Dave Kranzler. Over to you, Andy.
Well, thanks, Shane. And I tell you what, it's a real buzz to have Dave Kranzler with us here again. He is a favorite. We've had so many requests for Dave. And in fact, I must say, last time we had an episode here, people should, honestly, I'm saying people should subscribe to his mining stock journal amongst his other offerings. But essentially, he was so kind to share us he just happened to roll off his tongue. He said, yeah. I said, well, go on. Is there anything you'd prepare, happy to share with us? He said, yeah, Cabral Gold. He said, I like that a lot. I really like that a lot. I thought, oh, okay, then Dave, I'll go buy. I actually went and bought some. Well, talk about good timing. That was Dave, let me just welcome you and say thank you for that lovely gift. I hope a lot of you guys took that up. But if you didn't, there is plenty of opportunities to subscribe to Dave's service, Mining Stock Journal, and Investment Research Dynamics covers a short sellers journal, Mining Stock Journal. There's so much stuff there. But I would encourage everyone. But thanks for coming on us to join us again, Dave.
Thanks for having me back on, Andy. It's always a pleasure to be here. And by the way, Cabral Gold will be the gift that keeps on going. They actually may start a trial mining program by the end of the year if everything goes smoothly. They're already permitted for it, and they're in the process of putting together the appropriate economic study, pre-feasibility study that'll allow them to get it financed. So, and if they get that up and running, that'll fund the advancement of the rest of the project. And it's very high grade open pit gold. I mean, this thing should be a massive home run.
Well, I mean, this is what I mean. It's like finding things like that requires so much research, requires so much digging around. I mean, to me, that would be a needle in a haystack, literally. And I don't know anyone else that even recommended it. And everyone I spoke to about it said, no, I never heard of that. It's like, and so I think this is what you get when you go, you need to pay for certain services. If you're looking for stuff free, yeah, great. I mean, all well and good. But I think if you're serious, then I really think that Dave's service there Dave, what does it cost?
It's $20 a month. I probably need to raise it. I've had many subscribers say you're not charging enough compared to what other people charge, but that's what it is right now.
Yeah, well, I mean, there you go. That could be even the problem, because goodness me, that's ridiculously cheap.
I've thought about that psychological aspect of it. I just really enjoy doing the research. I enjoy writing it. I enjoy finding new ideas, and I like to look for. I mean, like you said, you asked other people about Cabral and they hadn't heard of it. I mean, Cabral puts all its money into the ground. I don't even know if they promote it all. You know, maybe they show up at conferences, but, and the CEO, I mean, he buys shares in every financing they do. He's the largest individual holder. So.
Is this financed literally by small investors, institutionals? How's that financed?
Some institutions, yeah. I mean, most of these junior project development, microcap stocks, they're predominantly financed by retail. But, you know, when one catches the eye of a big investor or a strategic investor, you know, like a big mining company that takes a position, that's what I think the next stage is for Cabral. At some point, there's going to be a large mining company that makes them an offer they can't refuse for a joint venture to develop the property.
Do you cover silver?
I do.
Yeah. Now that is also a love of many people I speak to. So look,
it's a love of mine, to be honest.
Yeah, really. And especially as we now see, finally, with the first quarter out of the way and these huge cartel derivative bets at $25, capping that bloody price from rising. And what it did, Dave, as you know, is that created this massive disconnect. This is an interesting dynamic because there we have this capping project. Every other asset class rising. And, you know, poor Bill Murphy and all the people who know so much about this stuff are pulling their hair out saying, what's going on? This is ridiculous. And it is ridiculous. And what happened was, by capping the whole first quarter, while gold was starting to rise from February the 13th, gold started rising $200 higher. Silver barely moved. And any move up was knocked back. And it was clear. And you know, our liquidity providers saying, hey, no, there was a huge spot market cap in place at $25. It wasn't going to get over it. The very day after, on really, as soon as the first quarter was dusted and this position was squared, suddenly we see silver now starting to perform. But I think the thing that got me, Dave, was because we're on the wholesale side of the market. And I was talking to Robert Keynes, and he's telling me that on the retail side, people are dumping their silver. They're really selling it at a discount. Why? Because they see this asset class synthetically capped at a price which seems to be going nowhere, and they're looking for other alternatives. Well, that was part of the cartel plan. But at the very same time, there were orders, we were being rung by refiners saying, have you got any silver? We cannot fill 2,000 tons. And it turned out to be nearly 2,500 tons of Indian silver demand, which we just need it at spot, but nobody had it. And clearly they weren't going to sell it. So you had this divergence between the spot, the retail price, where everyone's selling it, and at the same time, you've got a massively strong wholesale market. So any thoughts there?
Well, yeah, I've chatted with Robert about that in terms of all the selling that he's seeing. And to be honest, I think a material percentage of the people that are coming in to sell him silver actually need the money. So they're selling their silver rather than taking out more credit card debt to make ends meet. But I don't know. My view is that, I like to see what's going on in retail in terms of the flows, at coin dealers, but they're not a big enough segment of the market to be price setters or to really influence the price, right? I mean, they influence the premiums because when silver takes off and everyone flocks to the coin dealers, all of a sudden the premiums shoot out again. But I think what's interesting to me, and I'd love to hear your take on it. I mean, you've seen the Silver Institute forecasts, and I mean, I guess last year the silver market was in a supply-demand deficit, and it's going to be a bigger supply and demand deficit now. And my theory is that the bullion banks are doing what they can to try and keep the price from really taking off, like it did in 2010 and early 2011. Because I think there's the potential for a big short squeeze in the physical market. And I mean, you're closer to the physical hub in London than I am, obviously, and you see it every day. So I'd be curious to hear your take on that. But that's kind of what it feels like. I mean, if you look at the latest Commitment of Traders report, and yeah, it's already over a week old by now, but the banks on the COMEX have been piling into the short side on silver, and it has to be to try and keep a lid on the price. And another aspect that no one really thinks about is because there's not really enough information to allow you to wrap your head around it. But keep in mind that there's 3 or 4 large bullion banks that have very large OTC silver derivatives positions, and there's no telling what those look like and what their potential obligations are under those contracts and what the potential counterparty risks are. So, I mean, I'd be curious to hear your take on what you're seeing in the physical market.
Well, that's exactly, you just nailed it. Exactly that. As I said, this is the over-counter market bets against 25. It was a hard cap, no matter. But what that did was drove the ratio trade to 90-1. This is ludicrous stuff. When you actually, on the other side of that trade, you look with your eyes wide open and you say, hang on, I'm getting calls from Heraeus, from Valcambi, from all these refiners saying, do you have any silver? Can you point me to someone who's got any silver at spot? Now, it has to be at spot because Indian buyers need to buy it at spot. And of course, but in the meantime, the spot price now is starting to rise. And they were trying to buy it at 23. They're trying to buy it in the low 23s, the higher 23s, 24s, trying to buy just nothing coming to market. These guys, this cartel, what they call the professional trade, they call themselves the professional trade, literally was sitting on that price. Now, the thing is that actual derivative trade is now squared. And I think this is where to me, this is where what my liquidity providers, first-tier liquidity providers, they're usually very accurate. And everyone has their own idea around this level. But we had a move through 26.22 this morning in Asia. Indian buyers coming in, just literally. Now, thing is, that is the last, I don't know where you see yours, but this is what our liquidity providers think is the last fight line before literally they have to throw in their hand. And I think we got non-farm payrolls coming up. Yeah, we're going to see a fight at this line, but essentially we've been through it. But if it can hold, I believe, and we all believe, that if it can hold after non-farm payrolls gaming, it's going to be a beat, of course. It's always a beat. It's a politically sort of beat. But when we've had the non-farm payrolls beat, should I say, if silver can pit close above 26, 25, let's say in round numbers, I think that's it. I think they literally have to fold. And there's just too much residual buying. And then the other thing, Dave, is and this is another thing that Robert Keynes brought up. He said he was at a show, essentially, minor show, and that Tesla, I know you love Tesla, Tesla, who I know you hate, actually, were actually buying, but literally financing a Mexican silver miner directly. Why is this happening? Now, we hear of other people doing this. I don't know, I'm going to ask you whether you hear more about this. But literally, because it's the expression, pigs get fat, hogs get slaughtered. These guys when they have 2,500 tons of demand that they refuse to supply because they have the bullion, but they're not selling it at a spot price. So when you starve the market, when you play those kind of games and you create that, what you've done is create a situation almost like March 2020, when we saw like an $18 or rally in silver, because while that was COVID related and the refiners were shut down, this is synthetic and the refiners can't get it. So therefore, you've got to create a coiled spring here where at some point, and also the more people the more institutionals, like could be Apple, it could be Samsung, it could be Tesla, it could be anyone that says the hell with this game. I'm just going to go and put some money up, finance, and I'd be assured that my assembly lines will have the required silver because I don't trust this bloody market anymore. So what are you seeing? Because I see this as an explosive situation.
Yeah. In fact, I just kind of was looking at a chart of silver, a daily chart. And I mean, I follow the front month future contracts because that's what I trade. So May silver is the front month right now, and it's pushing 27. So, but if you just look at more of a spot type of contract, it looks like if silver can break above 26.50, it's lookout above, and I think that's when you'll start to see silver short. They're either going to double down their bets, which they could do, right? Because I mean, they're doing it with paper. All they got to do is print more contracts, or they're going to scramble to cover. But here's what's interesting, and I actually write about it in the opening salvo to my next mining stock journal that'll come out tomorrow afternoon. I think, silver's even a more opaque market than gold, right? I mean, there's no telling how much silver that goes into China because they don't report the import numbers. And I know they have a massive solar program going on. I was just on the phone with a Zoom video with the CEO of a silver producer over there, and he sells every ounce he can produce over there. And I asked him if that solar program was still going on. He said, yeah, it's huge. They need a lot of silver for it. But it feels to me, and again, I think the nexus of it is London because, right, that's where the physical bars are sourced and trade that go to the east or go to the refiners in Switzerland and then go to China and other Eastern destinations. It feels like there's a scarcity of free title silver bars. When I say free title, bars that haven't been hypothecated, right? Delivered, but kept in the London vaults to multiple parties per bar. And it feels like there's a growing shortage of that. And it feels kind of like the bullion banks are having to scramble to find free title bars that they can ship over to all destinations in the East. And one of the reasons, or one of the things that I think could support my theory is, and I'm sure you've noticed this, historically and typically going into the AM London fix, they push the price of gold down using COMEX contracts. And you always see, so in New York time, the fix is 5 a.m., and you always see this price start diving at 4:30 a.m. Lately, last at least 2 or 3 weeks, I've noticed, not every day, but on most days, the price is shooting up into the AM fix. And that kind of tells me that the banks took on obligations during Asian trading hours that are going to require them to get a hold of bars and deliver them over into Asia. Is that what you're seeing?
100%. In fact, I've just done an episode exactly that encompasses that. Since the 25th of March, the AM fixes, gold fixes, have come into play. And what it is because it isn't Indian buy. Now, normally the AM fix is an Asian fix, basically, and the bigger fix is usually the PM fix. And usually that's Indian buyers. But Indian buyers have gone away for the moment in gold. It's just too expensive for them. Mm-hmm. They've got to get used to the price and they'll come back in. But they're focusing on silver. And so there's huge demand for silver in India, which has kind of sparked this shortage by Indian buyers and Indian refiners. So essentially, we see this as a huge opportunity. Basically, this is a huge opportunity to realize that silver is about to break out. Silver has to break out from here. Now, gold, because we're talking about the ratio trade here. Now, what is it going to be? 200 to 1? I mean, come on. AM fixed gold is, since the 25th, it's been higher and higher. It's Chinese buyers. Indian buyers have gone away. Chinese buyers. Chinese cannot get enough gold. We've seen it every single day. Then you get the pit open. And what happened is, oh yeah, these guys come in and sell. But they're getting picked off. They're getting picked off time and time again. Why? Because it's a physical market. And people have forgotten that while the COMEX is non-Basel III compliant, it's just literally a paper market. Every other market, the minute you EFP a gold contract into the London over-the-counter market, which is NSFR compliant, which has to be physically backed by every single liquidity provider, that is a problem for the cartel. That's a problem for the Fed, because the Fed or the PPT, who are behind all this price suppression, they're losing control of gold completely because of Basel III standards, because you can now take a COMEX contract, you can EFP a hell of a lot cheaper than me flying it over, for God's sake. It comes into to the over-the-counter market. I can EFP it, and I can take delivery T+2 at a very tiny premium to what I've to really basically spot. Can't do that with silver. Silver is not NSFR compliant. So you EFP a silver contract, it stays unallocated. So it just circles right back into the same cartel hands to go round and round again. But Indian silver buyers and other people I know now are going to the COMEX, because no point in EFPing it. You go straight, Muhammad comes to the mountain, and it is taking physical delivery at the back door. And we are watching huge open interest being converted. And bearing in mind, you only have to have 4% to control a silver contract. All of a sudden, you've now got to refinance the entire thing. When it goes into it can't be circled amongst this daisy chain of banks. Suddenly it's demanded for physical delivery. You have to fully pay for that. And that means draining liquidity at a rate which we haven't seen before. Dave, I think you're right. I think we're at the point, so many things going on with silver. I think they cannot control it. They can keep adding more supply, but it's bouncing. People are coming and saying, well, give it to me then. And the COMEX is the only source where I can know I can go and get a delivery of 400 tons of silver without messing about.
That's interesting.
So, yeah. And I think, we're this is in the rear view mirror. I mean, yes, you're looking at gold and silver today. It just keeps going up. But silver seems to have broken out of this 25 cap. And obviously we don't know the extent of all these derivative trades. We do know it was being capped at 25. I don't know where their cap is right now. It's possibly at the 26s somewhere.
In terms of the May contract, it's at 27.
Yeah,
because silver's having
exactly
a heck of a time trying to get through 27. The cap before on gold, at least on a futures basis, was around 2180. And when that's when, once it got above that, it shot above that not that long ago. And I mean, it's at 2300 in terms of May silver, the front month basis.
Yeah. And we started on the 2nd of January, we started trading spot. Gold was 2055. Our liquidity provider said, yeah, but we've got a higher stair step, central bank stair step. It's at 2000. If it goes down there, buy the shit out of it. Just buy it. Right. So that's exactly what happened. They were stupid enough. And in fact, I think because, like Bloomberg said, Bloomberg did an article saying that the CTAs control 75% of the oil markets, the silver and gold markets, the paper gold market. So there's an immense momentum trade there once they got on the wrong side of it. And I think they screwed up royally, because when they did that in gold, when they actually started tricking out these CTAs to sell them, because the dollar was rising, it went from 101 to 105 through the first quarter, and but when it hit 105 on the 13th of February, that's when it hit that central bank bid. Then we saw a $210 rally, almost without a pullback. Why? Central banks jumped in. And I think they blew it. I think they didn't realize that once you trigger a momentum trade, be careful what you ask for, because you've triggered a momentum trade that you couldn't actually. It hit, you should have front run those. And every liquidity provider I talked to said they should have front run those. They should not have let them fill. And yes, the next level orders would be 2250, which is where they're probably now aggregating. So it's really interesting. I think they blew it.
It sounds like it. I mean, that's kind of what we saw in 2010, 2011, and it got to the point where, the banks, in the final run-up, the banks were scrambling to cover their shorts. And, I think we'll see that again. It may be a ways off. I hope it is, because I'd like to see this move have some durability, and I don't want just momentum chasers to pile into it, get a parabolic move, and then it reverses.
Yeah, that's been the problem all along, isn't it? It's these. Trouble is, with gold, of course, we used to have pretty close to 800 in 2020, 800,000 contracts of open interest. It dropped down to just above 400,000. Yeah, it's gone up a little bit now, but the thing is that is just not enough open interest to really, and especially as some of these guys, since Basel III NSFR standards came in, some of these guys, while they're traded, these CTAs, a lot of them aren't authorized, aren't mandated to buy physical, so they're forced into the paper market.
Oh.
The US centric, you have to trade that futures trade or ETF trade, and so. But the thing is, a good percentage of that open interest, which is normally rinsable because they're just running in and speculating, are actually using gold for what it says on the box, which is basically, I want to stay in the risk markets, in various risk markets. I need a hedge. It's equal, if not better, than a US Treasury in qualification as a first-year asset class. So these guys are becoming hard to rinse out. We haven't seen that in silver yet because it's just not compliant yet. But I still think the ratio trade is exposing anyone who's exposed to the physical market is looking at that and going, something majorly wrong here. It has to be an opportunity. 90 to 1. What is it going to be? 100, 150 to 1? I mean, gold's going up 25, 300, $3,000 this quarter, I believe, this quarter. So even if we get little pullbacks along the way, you can't cap silver and go into the hundreds again without something actually breaking, in my view.
I don't disagree with that. And I was actually looking at a chart of the gold silver ratio a couple days ago, and just from a visual, technical standpoint, it looks like it really wants to go lower. And if that happens, that means silver's going up at a faster rate than gold, and that's when the real fireworks will start.
I think personally, I think silver will outperform a rising gold price.
Oh, I mean, if this plays out the way the rest of the bull cycles have since 2001, I mean, it's guaranteed silver at some point will start vastly outperforming gold. I mean, we saw that to some extent yesterday. I mean, silver was up well over 3%. And gold was up over just 1%.
And I think we're just seeing if you move back to March 2020, when we saw the beginning of an $18 rally, at least in silver, which was again physically driven, then essentially a lot of people back then were saying, well, it's not going to do it. It's not going to go up. I mean, good God. I think when we started trading gold on the 2nd of January, through to February, because the dollar was rising, all these technical analysts were saying, oh, it's 1860 for gold.
I remember that.
Hang on. Where are you getting that from? That is nothing to do with the physical market. That is like, well, don't forget there is a physical market to this site, to this paper game. And it was ludicrous to even think that we would even go down that far. But it's almost self-fulfilling, with people say, well, I better hold back. I won't get in. And then what happens is, then it takes off. $200 rally from the 13th of February, when it hit the dollar at 105. Well, dollar's at 105, pretty close, knocking on the door at 105 right now. Same level, except how much higher are we? $230, $250 higher? That sort of tells you something. It kind of tells you, while the dollar's rising, is rising against other fiat crosses, and it's dislocated from the other big foreign exchange cross, which is gold as money.
Well, that in terms of the 1860 calls, there was actually one guy out there who, like, within the last month, I believe, said gold's going to 1200. I was like, what? In what universe will gold ever sniff 1200 again?
Well, that brings me to your short sellers, your short sellers guide, which you, what do you call that? You call that your
short sellers journal. Okay,
so there is times. You're one of the few, very, very few people that I know that are equipped to look at short sales in a business-like way and an unemotional way. I'd like to know, I mean, you just gave an example, a ludicrous example of somebody who was probably talking their book, but what I saw a recent article, and it was that you wrote, really good one, and it was about the CRE sector, and there was a particular bank in there that you were pretty much warning was going to go to zero. Can you expand on that for us?
Oh yeah, that's New York Community Bank, and it was on its way to zero. And the former Treasury Secretary under Trump, he put together an investment group, and they basically injected capital in and took a position in the bank. I mean, that stock, it was, when I started following the story, it was like above $10, and it looked like it was headed towards zero. It was well below $3, and then this guy gets involved, and the stock pops. I'm sure part of it was short covering, but it's actually come off quite a bit since the initial price surge. I don't know what his intent is with this thing, because they're sitting on a lot of commercial real estate that's probably basically worthless. And it's both multifamily and office buildings. They took over, they acquired I think it was a California bank. I think that's where it was based. And that bank has a mortgage servicing business. And my understanding is that's what he's after. So he'll strip out that and just discard the rest, get what he can for the rest. Because the mortgage servicing business is I mean, you're at it can be risky, but until it gets really risky, they're cash flow generating machines, and I think that's what he's after. There's actually another bank that's New York based, and they're essentially way underwater. They're way upside down in terms of the value of the commercial real estate that they've lent against versus the amount that they've lent against it. And they've got, I mean, it's just incredibly leveraged to commercial office building. Again, office buildings and multifamily. And one of the things that because people usually think, oh, well, multifamily's safe. We got to have, people need to rent, people who can't afford homes. Well, there's a massive amount of multifamily capacity coming onto the market this year, and that's going to drive down rent prices. And it's going to make multifamily debt toxic. And that's one of the things we have ahead of us.
Wow. And I think this is another thing that shoe, CRE shoe is beginning to drop. It's also, I mean, look, let's face it, all these markets are interconnected, and we're going to feel it this side as well. And again, it's just one big circle of investors, and basically daisy chain of these guys. And I think, so it's interesting because we've been very, very worried about this CRE shoe getting dropped again. And so what is telling, what are you looking at? Is it the 10-year yield what is it that is telling you to pay real close attention?
Well, yeah, I mean, now that you mentioned the 10-year yield, it's the yield's kind of breaking out again. And, 435 was kind of considered a key technical level, and it's at 442 right now, at least when I checked an hour ago. But to be honest, I'm not sure, even if the Fed were to cut rates, that's not going to bail out commercial real estate. And it's what's amazing to me is it's like a black swan hidden in plain sight. I mean, no one's seems fearful of the potential consequences, and it's going to come. One of the reasons why you're not hearing about a lot of defaults right now, I mean, you're hearing about defaults, and there's buildings being sold at 30 cents on the dollar versus the amount of debt outstanding, but a lot of the lenders right now are willing to restructure in terms of extending payments, extending maturity, etc. But you can only play that game for so long, and then at one of these days you're going to kick the can and it's going to hit a wall and bounce back. And there's no telling what the timing is on that. Maybe if the Fed takes interest rates down drastically, it might fix part of the problem. But I think what we're looking at here is unless the Fed's willing to let the whole commercial real estate debt complex collapse, they're going to have to monetize it, which means there's more QE coming. And I think that's one of the things driving the price of gold right now is the price of gold looks at this situation and says, it's either collapse or print. And so I think right now the gold market is saying we think they're going to print it. They'll play chicken as long as they can, and then at some point they'll have to start monetizing it. So, and it's just amazing to me that the market's just completely ignoring this. And the other thing that no one talks about and you don't hear about, but it's there, is that that one of the the apologists say, well, the regional banks are going to have a lot of problems with commercial real estate, but the big banks. And when I hear that, they're specifically referring to the 6 or 7 too big to fail banks in New York. Well, and plus Deutsche Bank, they have to have a massive exposure to commercial real estate via over-the-counter derivatives, because a leopard doesn't change its spots. And what happened in 2008, yeah, the on-balance sheet debt was a problem, but it was the OTC derivatives that were off-balance sheet that almost blew up several banks. And I think we're gonna see that again this time around with commercial real estate, credit default swaps and interest rate swaps. And there's no telling how big their exposure is, because the accounting changes that were made in 2010 that were supposed to clean up the derivatives problem actually made it easier for them to hide this stuff off balance sheet.
Well, that's why you hear such the sound of silence here from all the mainstream media. This is an interesting subject. It should be on the front burner. I mean, occasionally Bloomberg raises it, and they usually bring someone on that says, "Oh, yeah, I'm not too worried about it." And it's like, there's definitely been some vested interest clearly here that's keeping that story
absolutely
well under the radar. And as you say, you're going to wake up one day, and it'll be the next shoe has dropped, and it'll cause this daisy chain to unfurl again. And good God, I mean, what happened in 2007, 2008 was handleable in the sense that you could move some of this stuff around. and hide it. Now that's what's being focused on. It's all that stuff, and it's coming to roost again.
Yeah,
and it really amazes me that people who aren't buying gold and silver for an investment aren't just literally trying to protect their assets by having some exposure to it. And I think they probably are. And this is probably what we're seeing, as you say, this is part of what's driving it, because other than foreign central banks, every other bank other than the Fed, put it that way, is buying physical gold to kind of try and prop up they probably owe about 4% backing to most of these fiat currencies. But not China and Russia and the BRICS countries, percentages will be a lot higher. And I think so really, yeah, I think what we're seeing here is some very smart money buying. These central banks are exchanging their dollars quickly. And when you see a rising dollar price, it accelerates. So they're changing their dollars for gold, or exchanging their depreciating dollars for gold. But also, we're also dealing with people in the US-centric side of things, and also institutional investors who are saying, you know what, even if it's paper gold, I need some. And we're recommending paper gold, but if you've got no other alternative and you are in the risk game and you are chasing stocks into bubble levels, or you've got other risk assets you need to back up, US Treasuries aren't really offering you much protection at this point. And if you do your homework, then the least risk is physical gold.
Yeah, I agree. Is the ECB buying gold? I haven't seen reference to that.
No, there's no reference to it, but what we can see is the Bank of International Settlements. We can already see the Fed starting to cover their swaps. And remember, they started 2003 trading with zero. They'd literally, the Fed had repatriated 500 tons of gold, and they made the mistake of adding some BIS swaps along the way. And I think that's now unwinding. And I think that's why we look at the ETFs and the borrowings of SLV, of GLD, also the borrowings of SLV. But because that maybe the back door for them is to spin. You need to spin some wheels here. So go and borrow something from there in the hope that you can get a bit of a discount and pay and buy those back. It's not happening. They're just not getting there. And I don't know if you saw recently, we saw it was just 2 weeks ago, we saw the cost to borrow SLV spike to nearly 80 basis points. You can't make money of that. That's ludicrous. That's ridiculous. That is somebody panicking to do something nefarious, clearly, or had to repatriate. And the same in gold. We saw massive premiums to borrow GLD. What's going on here? There's all these pieces of the puzzle are actually in front of us. It's just a question of focusing on them and seeing them and not being fooled by the intraday bullshit action that we see.
I've been curious about that in terms of who would be the ones, who do you think would be the ones borrowing massive amounts of SLV and GLD? My initial gut reaction is that, oh, well, that's the bullion banks trying to cap the prices of gold and silver by shorting GLD and SLV. But do you think it's possible it might be CTAs putting on a hedge? I don't know, against their silver and gold longs.
I think you're right. It's a mixture of things, but I think CTAs can be doing that. But I think when we think about it, especially in gold, and I think more to do with gold, as Basel III compliant. So we see none of those bullion banks, not a single first-tier bullion bank that I know of, and we know their desks, and we know the people that interact with them, are short a single ounce of gold. Probably not short a single ounce of silver, but not short a single ounce of gold for their own book. They're acting on behalf of the Fed. So anything that's happening like that is really to do with the Fed trying to scramble together and manage the price of gold against the dollar, manage the price of gold from breaking out. And I think what options do you have? You can't, because what's happening is when you print paper gold and put it into the system, the COMEX system, somebody wakes up and says, well, okay, I'll just take that, EFP it, bang, into the over-the-counter, I'll take delivery. End of. Thank you. You can't do that. And I think this opens up a whole nother question because, and I think it's my view, and I don't think everyone else agrees with this, but I think certainly the Fed has to fold its hand at some point because you can't have every other central bank globally buying gold and you can't fight that. The Fed is not big enough to fight that. So I think what they're doing is you've got something like 59 billion in the last 3 months, less than 3 months is going into Bitcoin ETFs. Well, you know where the stops are. You've got 11 exchanges in there. Someone's financing these guys. Someone's financing this stuff. Well, you know where the stops are. So I think what's happened is what the old game, which was 50 years of COMEX price suppression, has now reached a point where, hang on, if I do this anymore, they're going to take my physical. They're going to convert it into physical. So maybe it's better I play the game in the Bitcoin ETFs. And if I lose, and yes, the Bitcoin will probably keep going up. Who knows? I mean, perhaps it will. But it doesn't matter if you can just, you're in the money printing business. You can soon cover those positions just by printing money. But you can't cover those positions by delivering physical gold you don't have. So I think the game has actually, look, is it a dollar competitor? Yep, it is. Is it, if you wanted to do some gaming and try and protect dollar hegemony or slow down the race out of the dollars, then to me, it's a logical move. I think the Fed has to fold their hand.
You know, that would be the rational solution to the predicament they face, right? I mean, the Fed may be short as much as 8,000 tons of gold that they've leased out over the years to the bullion banks to go and dump on in London to control the price. But, and I hate to sound like Nostradamus, but, you know, when I got pulled into the dark side back in 2001, and I would spend literally 18 hours a day researching and reading everything I could get my hands on. A lot of what I used to read, a lot of the guys I used to read, I've kind of discarded them. And there's certain guys I pay attention to, you being one of them, of course. But I kind of came to the conclusion that if in fact the Fed is in the predicament that we think that it's in, and obviously there's no way to for sure prove that, I think Germany tested it, and we saw that, right, when they wanted to repatriate, something like 800 tons of gold, and they settled on 300 over 7 years. Yeah. When meanwhile, a couple years earlier, Hugo Chavez down in Venezuela was able to repatriate 200 tons of gold in like a month. So, I think, again, we don't have hard concrete proof unless we could actually go and visit the vaults. And the the Fed wouldn't let the Germans visit all 9 of the vaults where they supposedly were holding German gold. They said, okay, well, we'll let you visit one vault. And that's what triggered the repatriation, I'm sure you recall that. But I kind of always felt that rather than expose itself to the world for what has happened and what it's done, I think the U.S. would rather start a world war and deflect attention from any of this, which a world war would do. So, and, that may be part of what's going on in terms of, the U.S. imperialism and belligerence in several locations around the globe now.
Yeah, you're right. That's always been that's what's happened every time in history, hasn't it? When things get really broken, then it's time to just literally start a war. And we can see an awful lot of posturing, whether it's Ukraine, whether it's Gaza, whether it's Taiwan. You can see
South China Seas.
Yeah, and these are huge risks. Interestingly, the BRICS 10 meet next month between the 14th and the 19th. And Glasgow's currencies have been beta tested and are being launched or proposed at that BRICS 10 plus meeting. And it's already been beta tested. It's been greenlighted. Be interesting to see, because most people are concentrating on one of the baskets, which is the SDR basket. Well, forget it. There's too much foreign exchange imbalances to be able to really put that into play. But a gold and commodity based currency is plausible. They have the gold to do it between China and Russia, and really the BRICS nations themselves. There's enough gold there. They control the lion's share of the multi-trillion-dollar energy and oil markets, and they're not only buyers, but they're sellers. And so it makes no sense to deal with the dollar whatsoever for them. And this is a logical solution. And given that there's been very, very serious escalations this week alone, with Iran being bombed directly by Israel, the suspicion over the Russian so-called terrorist attack, Taiwan escalations. What's to stop these guys saying, "Well, let's at least get that going"? And can you imagine it would make sense, because you know that there will be probably a war. You need to insulate yourself at this point. They got their eyes wide open. They know that something bad is going to happen. What are your choices? The best financial nuclear war would be held by literally moving the energy trade over to that gold commodity-backed currency. That would severely undermine US dollar hegemony in a stroke. I can't believe that this has not been on the front burner for before. Escalations have now got to the point where you and I are both saying, "Oh dear, it's not looking good," and it would be the perfect time to start a war. So let's just see next month, 3 to 4 weeks from now, we will know if that is adopted quickly. It's already been greenlighted, and beta tested. Then it changes the game completely. We're going to see $3,000 gold.
And that may be another dynamic that's causing gold to do what it's doing. I knew about the meeting, but I didn't realize that they were this close to rolling out an alternative gold-backed reserve currency.
It's been green-lighted, and it's been about 3 weeks ago, and it has been beta tested now. And I think it's got all the systems in place to turn it on.
I mean, if that does happen, it's a game changer, and the United States is going to see price inflation like it's never experienced.
Yeah. Can you imagine what would the price of oil be in dollars if you could trade it in gold? Lord, I can't imagine.
Yeah. And I think the U.S. is worried about that, because I just saw a report out that said they've stopped filling the SPR.
Yes. Interesting.
Perfect ahead of a war, right? You go into a war with a depleted strategic petroleum reserve.
and I would imagine a lot of the ammunition and weapons have been deployed in the current wars. And so it's not exactly, everyone's not exactly flush and ready to rock and roll.
That's right. And the cost of producing that stuff, if they want to try and ramp it up even more, is just going to keep going higher.
So then maybe they'll just be happy with making the money on producing the weapons.
Well, I think that's a big part of what drives it, to be honest.
Hopefully greed will supersede the need to actually try and find that war solution and impose that on us, because they're making a lot of money out of this. Maybe they should just let it play out for a bit longer and then panic.
I don't know. Based on my observations, these guys running the U.S. Department of Defense are insane. They're crazy.
It is. It's quite frightening. So really, I mean, we've covered some stuff here, Dave. I would have loved to get into some other things there, but I mean, we're just going to have you come back if that's all right.
I'd love to.
I do recommend, honestly, because obviously when we start to get close to an hour, then people start getting fed up and tuning out. But I honestly recommend if you could put some links in for us, and especially there's a couple of charts we talked about, that would be just excellent. People, I really do honestly recommend people come and land on your website and basically come and find out what you're doing. There's some options there. You've got the Short Sellers Journal, Mining Stock Journal, a lot of amazing research. Investment Research Dynamics is obviously the website. Anything else that you do there?
I mean, I do the blog posts. I don't do them as frequently as I used to, just because there's so much writing involved with both of my newsletters. But that's pretty much it. It's kind of the driver for my Mining Stock Journal and Short Sellers Journal. And occasionally when I need some couch time, I find, writing a blog post is a good way to ease the tension in my mind, quell the voices.
Well, it's been such a buzz. Thank you so much for sharing that time with us today. It's invaluable. There's so much information here. It's all about education. It's about putting pieces of the jigsaw together. That's what the idea of this show is. And so really, thank you for joining us.
Thanks again for having me on. I always enjoy it, Andy.
Thank you.
Thank you, Andrew Maguire and David Kranzler, for another fascinating discussion. And remember, to our Live from the Vault community, buy physical, and make sure it's 1-to-1. And understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. So there you have it. That's all we have for you today on another episode of Live from the Vault. And again, remember to help us spread the word about this channel by hitting that like button, sharing this information, and be sure to subscribe if you haven't already done so. And if you want to be notified in real time as each episode goes live, just click on that bell and we'll do just that. And with that, we'll see you next time right here on Live from the Vault. See you then.